So the tax system in our country is designed to be progressive. This means that marginal tax rates increase as an individual's income increases. In order to calculate an individual's tax liability, we first have to calculate his taxable income. This number is analogous to a firm's net income. It represents the taxable portion of the individual's income after subtracting tax-deductible expenses. So we already learned that if a firm uses debt financing, for instance, it can take away its interest expense before paying taxes, which means it's saving that money that it otherwise would have to pay tax on that interest expense. So that interest expense is tax deductible. And individuals and families have similar ideas that are based on maybe their family size or a host of other factors that lets them deduct certain expenses from their taxable income. So it's the same idea with an individual as it is with the firm. So once we find this number, this taxable income, we have to look at a table of tax rates to find what tax bracket the individual falls in. So let's look at a sample one of these tables now. So here's a sample tax table for single taxpayers in the year 2009. And so this first column we see is the lower end of the interval of each bracket. So we're splitting, this table splits everyone's different income into these different brackets. There's 6 of them. And if your income falls within this interval, you use this information to figure out what your tax obligation is, your tax liability, the total amount of dollars you owe to the IRS. And so this is the bottom part of the interval right here. It's called the base. And this is the upper part of the interval. This column tells us it's a fixed dollar amount that you pay if you're within this interval. So if your income lies between $8,350 and $33,950, then you owe a flat rate, you owe a fixed dollar amount of $935, and then you additionally owe the marginal tax rate on any dollar amount that you earned over the base. So let's say you earned $10,000. Well, you'd fall in this category right here, so you would owe $935 plus 15% times the difference between the $10,000 you earned and the base number of $8,350. So that's how this tax table works. So let's look at an example. So suppose an individual has an annual salary of $70,000 with a personal tax exemption of $5,000 and a standard deduction of $6,500. So the personal tax exemption and the deduction are both ways that the individual reduced his net taxable income. So he's not going to be responsible for that. When we're looking to see where the number falls in this interval, we only look at the taxable part of their income. So after we've subtracted out all of these tax deductions. Let's also assume that he received $10,000 in capital gains. So maybe he invested in stock, the stock appreciated, and then he sold it, and so he received $10,000 over the year in capital gains. If there is a 15% tax on capital gains, what is his total tax liability? So the way the tax code works, it separates out your income that you're making in wages and salaries from your job and the capital gains that you make from investments. And so we just see that there's a flat tax of 15% on all capital gains. The $10,000 that he received as capital gains won't come into play when we're trying to find out the number that falls in this bracket. So first we have to calculate his taxable income to see which bracket he falls in. For this, we will ignore his capital gains as they are taxed independently of this table. So we start with his salary of $70,000, subtract his personal exemptions of $5,000 and his deductions of $6,500, and we're left with a taxable income of $58,500. Now we want to look where this taxable income falls within these brackets. Well, we can see it's going to be in the third one because it's over the base of $33,950 and it's not over $82,250. So this is the row that we're going to look at, the row that we're going to use to find out what this individual's tax liability is. So we start, the tax on his income is equal, the tax liability is equal to the tax on the base, which we get right here, the $46.75, plus the marginal tax rate of 25% on any amount that he's making over the base. So again, the base we get from this first column right here is $33,950. He gets taxed 25% on the additional money that he's making over, so it's the difference between his taxable income of $58,500 and minus the base of $33,950. So that's how we find the tax liability on his income. And when we calculate that, we see it's $10,812.50. But we also have to worry about the tax on the dividends that he made from his investments. And remember, the dividends were being taxed at a flat rate of 15%. His capital gains for the year were $10,000, so we just multiply 15% times the capital gains of $10,000 gives us a tax liability of $1,500 for the dividends. So his total tax liability is a tax liability from the income plus the tax liability from his capital gains, or $10,812.50 plus $1,500 gives us a total tax liability of $12,312.50. Now we can also ask what was his average tax rate based on his total amount of income that he paid tax on, both from income and from capital gains, and his tax liability, the total amount of tax that he paid. Well, we would just divide his total tax liability, the $12,312, by the sum of his taxable income and his taxable capital gains, and we get an average tax rate of 17.97%. So as we've just seen, the capital gains that bondholders and equity holders receive from their investments are taxable. There are certain types of bonds, however, whose interest payments are tax deductible. In general, municipal bonds, which are state and local government bonds, are exempt from federal taxes. Because of this, the bonds themselves typically have a lower yield on them. Whether or not it's worth it for an investor to avoid the federal tax by buying the muni depends on his net interest after taxes are paid. And that's the end of part 3.